But if you want to go to like the true, gold standard cookie cutter, coupon clipper, mailbox money deal, that's going to be your absolute triple net single tenant deal.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Dan Lewkowicz. Dan's a seasoned real estate investor and also a veteran of the show. It's been a long time. I was just looking back. I was telling Dan before we started recording, but episode 65. So if anybody wants to go back and listen to the previous one, we've probably both, aged since then. But yeah, it's been a little while. Thanks for coming on the show today, Dan. It's good to talk to you again.
Yeah, absolutely. Thank you so much. I'm excited to be back.
Awesome. Can you give us just sort of a brief rundown of your background so people new to the show will know, and then we'll just have a conversation from there?
Absolutely. So my name is Dan Lewkowicz. I'm currently the senior director here at Encore Real Estate Investment Services. I'm a net lease investment sales broker, which means that I help buyers and sellers. I advise and assist buyers and sellers in their transaction, purchase and sale of commercial property, specifically net lease property, single tenant net lease property, and multi-tenant as well, all across the country. I started out really as a house flipper. I still joke and tell people that I'm a recovering house flipper. I still do scratch that itch occasionally, but nothing like I used to. I have a background professionally as in a nonprofit fundraising, as well as title insurance sales. I ran the title insurance sales team previously, and I also am a former former business development executive for Amazon. So as I said, most of my real estate investing has been in the single family house flip and rental space. I've been involved in commercial real estate investing as well. But I also made a transition into the brokerage role about 6 years ago. And that's really where I focus, 99.9% of my energies and efforts and time outside of my own, personal real estate investing.
So what I heard was you basically, the 6 years in commercial real estate, you were a house flipper. I think we got most. I think you paused and then internet did something weird. So it should have all been caught on your end. I guess that's the good thing with Riverside, is it should be recording on your end, even though some of it caught out for me. So we should have it, and we can edit it together. So and like I said, we did talk before, and it's been 2.5 years, a rather eventful 2.5 years in the market. And maybe that's a good place for us to focus today, is kind of, what you've seen since then. I know when we talked before, the market was hot kind of in all asset classes, and now things have cooled off, although I'm not sure, what you're seeing in your specific asset class. So maybe you can speak to that a little bit, the changes that you've seen over the last couple of years.
Sure. I mean, listen, 2019, 2020, 2021, really 2022 as well were banner years. I mean, it was a great time to be in the industry, and I'm very thankful that I was. Essentially, it's very simple, right? So about 2 years ago, the Fed, as a response to the massive amount of capital that was printed and then infused into our economy, had to do something in order to prevent runaway inflation. And what was done was, as we know, interest rates were raised, and they weren't just raised a few times or a small amount. They were actually raised probably faster, more rapidly, and more significantly than they had been in the previous 4 decades. And if there's any one thing that you can do, one lever to pull to slow a market, it's really going to be to pull that interest rate level lever, I should say. Because really, if you look at it, those are the two means that the government and the Federal Reserve have, print more money or change interest rates, and they did both. So we saw a change in the federal funds rate of about 525, 550 basis points right? So 5.25, 5.5%. Now, obviously that didn't correlate, basis point to basis point into interest rate increases, but just to keep things in perspective, we saw rates go from roughly 2.75 or 3%, all the way up to 7.5%. So that's a significant swing. But what didn't happen was that cap rates did not move in lockstep, and they never move in lockstep with interest rate changes. If you look across what I do, fast food, pharmacy, discount retailers like dollar stores, even shopping centers, really we saw 50, 75 basis points of swing, maybe 100 basis points, maybe 125 basis points in terms of cap rate swing, in specifically the dollar store space, because those had compressed so much over the last decade. But nowhere near, that swing of 4.5%, or 450 basis points of interest rate swing that we saw. And really, if there's one metric that will tell you the vibrancy and the velocity and volume in the commercial real estate market, it's going to be that delta between borrowing costs and cap rates, right? The higher that delta is, the more fuel that's being injected into the system. Well, that delta became negative on many different types of asset classes, meaning it actually would cost you more, percentage rate wise, to get financing than you would get as a return for the property. So that caused a massive slowdown. I mean, that's just the way that it is. Now, across the industry, we saw tremendous slowdowns. Some brokerages reported, decreases in brokerage volume of 80 or 85% or more. I'm very thankful. My business has been booming. A lot of that I can attribute to the fact that about 2.5 years ago, I saw this coming and I pivoted and I started focusing more on shopping centers, on short-term deals with short-term or, soon to expire leases, as well as vacant properties, because those three classes were much less affected by interest rate swings. They were much more immune to that. Shopping centers, because their cap rates are significantly higher, so people can still source debt. Vacant deals are usually cash. Short-term deals, usually higher cap rate. So I really started pushing in those directions more, and it was very beneficial for myself and my team. But obviously, we've seen a tremendous slowdown in general. Now, we have seen over the last 10 to 12 weeks an uptick, and we get a lot of data because we do a lot of deals as a brokerage. So we've seen an uptick the last 10 to 12 weeks in new listings, in offers, in properties under contract, and closings. I can't point my finger to one or two or three variables that are really causing that, but I do believe that people want that safety and security of the net lease space. And I do believe that this real estate market is very healthy. The fact that it's still moving along despite all these interest rate changes tells me that it's healthy and it's robust. And I think that as we see upcoming interest rate cuts, we will start to see the market continue and picking up in its velocity and its volume.
Yeah, that makes a lot of sense. I think that a lot of the fundamentals within real estate, across asset classes, across most asset classes, I think I don't know that there'd be a lot of people arguing for office right now, but if in a lot of ways, most other asset classes still have really strong fundamentals, there's still high demand. The main challenge is exactly what you talked about, is that now that, the cap rates have not increased enough to offset the increase in interest rates that you're going to pay on your debt. So that's, people are having to get creative. People are, like you said, looking at those specific all cash deals, or a lot of people I've talked to in different asset classes, but looking at, a lot lower leverage, whether that's by choice or because that's what the lenders will do. But essentially, finding ways to still make it work. And you may not get the same returns, and that makes sense. You're not going to necessarily get the same returns in a down market as we did when everything was, euphoria and crazy, buyers or sellers market. So in your experience, you said business is still booming. Maybe talk a little bit more about, what about those specific assets did you see as, oh, that's the way I should go because of, what's happening, and how that's played out?
Sure. Well, I really got my brokerage start in, shopping center brokerage. So it was always something that I liked. Typically from a brokerage perspective, a lot of agents focus on single tenant deals because they're easier to underwrite. They're much more simple, usually, generally speaking. I didn't mind it. I like the numbers. I like the underwriting. I like, juggling the different pieces of all the different tenants to get them to a place where we can close the deal. So, really, again, the number one variable was that there was a delta, even at these relatively higher interest rates, between borrowing costs and cap rates. So that's why I really pushed into shopping centers. Further into shopping centers, I should say. In addition, what's great about shopping centers is they provide an opportunity for forced appreciation, kind of like we see in multifamily. So in multifamily, you can buy a property that maybe has a little bit of deferred maintenance. You can deploy some capital expenditure. You can reposition it, make it a better property. You can evict tenants who are not paying. You can, raise rents. You can lower expenses, et cetera, et cetera. That's going to force appreciation. That's why people like multifamily. So in shopping centers, you can do much the same, right? You can buy a property that's a little bit of deferred maintenance. You can deploy some capital expenditure, maybe lower the cap rate of the building, and also at the same time command higher rents because it's a nicer building. You can evict tenants who aren't paying. You can increase your occupancy. You can lower your expenses. And then this is one of my favorites. You can convert your leases over from a gross lease to a triple net lease. And I'll explain what that means. So typically in shopping centers, you either have, this is an overgeneralization, but it's for purposes of understanding this point. You either have a gross lease, which means that, let's just say, Know Your Why podcast, LLC is looking to rent some space, and they're going to pay $1,000 a month gross, which means that, Jason is only responsible for $1,000. Doesn't matter what the expenses are at the center. The owner of this property is going to have to pay for all the expenses. They're going to pay for snow plowing. They're going to pay to cut the grass. They're going to pay for management. They're going to pay repair, replace the roof. They're going to pay to shovel the snow and the sidewalks, et cetera, and plow. So that's a gross lease. Now a triple net lease is Jason. Now there's a few different structures, but so we'll oversimplify again. But so one structure, Jason is one tenant in a center, and Jason has, let's just say 2,500 square feet out of 10,000 square feet. Okay. So that means that Jason occupies 25% of the GLA of the gross leasable area. So Jason is responsible for, guess what? 25% of the expenses for the center. Property owner doesn't have to absorb those expenses, right? If the cost of gasoline and salt goes up and it costs more to plow the lot, doesn't matter. Jason foots the bill, not the property owner. Now, another way to do it would be the shopping center owner says, okay, Jason, you're going to pay, $3.45 per square foot as a CAM charge, a common area maintenance charge. And if at the end of the year, there's a reconciliation that needs to be done and the shopping center owner spends more than he bills, guess what? You're going to be, you're going to foot the difference. That's a triple net lease. So if you buy a property that has, let's say 10 tenants, 8 of them are on triple net leases, 2 of them are on gross leases, and their leases are set to expire, in the near future. When it's time to renegotiate the lease, you can say, hey, you're welcome to stay, but all tenants have to be on triple net leases, which helps you as a landlord for a few reasons. Number one, you don't have to deal with the unknown. You don't have to deal with the vacillation of expenses, right? You understand that you might have to be paying the money up front, but you're going to get reimbursed by your tenant. Okay. Number two, any new buyer that comes to buy the shopping center is going to look more favorably upon a center that is 100% triple net leases. So you can now lower your cap rate. So by increasing your occupancy, by evicting tenants that aren't paying, by deploying a little bit of CapEx, by converting leases from gross leases to triple net leases, by raising rents that are below market to market, you're now increasing your net operating income, right? You're increasing your essentially your predictability of what you're going to have to spend for your property. You're going to decrease your cap rate. And anytime you increase your NOI and decrease your cap rate, that's a recipe for success. So that's a great thing that shopping centers offer. They offer this opportunity to reposition them and either hold them or reposition and flip. With the other two that I mentioned, vacant properties, I'll give you a great example. Last year, I had a vacant Burger King listed for sale. I ended up working with a close friend of mine who's going to purchase the property and work with Starbucks to reposition and redevelop that property to a Starbucks, which obviously is going to be, they're paying significant rents and they trade at low cap rates. So he through that deal would be able to build up a massive amount of equity. So deals like that, I love. And then the short-term deals are very similar, right? When the lease is up for expiration, you can either renegotiate, which in many cases can be a big win for the landlord if they're paying below market rent, right? Especially once you get a new lease, or you can redevelop, put a new tenant in, get a new lease, hold, or flip. So that would be, kind of advantages of those three different types of assets that I really shifted my focus towards.
Yeah, makes a lot of sense. The multi-tenant shopping center, kind of the points that you made really they strike me as very similar to, sort of the arguments for multifamily versus, single family rentals, just in terms of having the ability to affect value kind of at scale. And
Yes.
one vacancy doesn't mean zero revenue coming in, that sort of thing. So
Correct.
I think it makes a lot of sense. The triple net lease is like, on its surface, sounds like sort of the most ideal way you could be a landlord, right? It's like, I just don't have to really worry about anything. Someone's going to pay these costs. What I often wonder, what's the catch isn't like the right thing to say, but I want, there's got to be some reason why not everybody's doing that. So is there, do you see any downside to, obviously that's your preferred space, and so I'm just curious if there's things that like maybe you've heard that are like why people would say, oh, I wouldn't do this? Because when I talk to you, I'm like, yeah, that sounds like a great idea. What could possibly be a negative?
Yeah, and that's a great question, Jason. So, what we've talked about up until now has been, primarily the multi-tenant shopping center space. And yeah, there are triple net leases within those spaces. Still, there's management intense, and there is some level of management intensiveness. It might be reimbursed by the tenant, but it's there. But if you want to go to like the true, gold standard cookie cutter, coupon clipper, mailbox money deal, that's going to be your absolute triple net single tenant deal. So that's going to be a corporate lease in on a great corner or a great area with high visibility, great traffic counts in front of the site, strong population density, great demographics, average household income, etc. It's going to be close proximity to other national retailers. And typically they're going to be long-term leases with, like I said, corporate tenants. So you're not going to have a guarantee with just, for example, you could look at, let's say, a fast food restaurant. One fast food restaurant, one Wendy's, it might look exactly the same as one 4 miles down the road. But from my perspective, it couldn't be more different. Because number one of the Wendy's might have a guarantee. It's, Jason and Dan Burgers LLC, and we're aspiring fast food operators. This is our first location, right? Well, that deal, guess what? Not a lot of security, because Dan and Jason aren't really great at it. We don't have a track record. And if we have a problem with our one location, we have to close down. You're not going to get paid. Whereas like the next one, 4 miles down the road, that might be guaranteed by Meritage Hospitality Group, a publicly traded company with, I believe 355 locations, right? Their guarantee is much stronger, is much better. So that's just an aside, kind of a side note to pay attention to. But as it pertains to an absolute triple net deal, keep in mind, you're not paying for anything, right? No taxes, no insurance. The taxes and insurance are paid for by the tenant. Any type of management, any type of maintenance is paid for by the tenant. If there's a problem with the roof, the structure, the parking lot, paid for by the tenant. Everything is paid for by the tenant. So you're getting mailbox money with zero landlord responsibilities. You don't have to live in the same state or country as your property. You don't have to go see your property. It's as hands-off as it gets, right? It's really a bond that's guaranteed by that, the guarantor on the lease, right? That's wrapped up in sticks and bricks. So downsides, what are the downsides? So I'm a straight shooter. I tell it to you like it is. So downsides are, you don't have diversification of rental income, right? You've got one property, one tenant, right? In the shopping center example with 10 tenants, like you said, Jason, if one tenant goes bankrupt or vacates or disappears, you'll fill the vacancy. You'll lose a little bit you won't have 100% of the income you had for a little while, but you still have the other 9 tenants. With a single tenant net lease deal, again, it's very rare that these major corporations go bankrupt, but they do. And when they do, they can get out of their leases, right? And it's happening today. Red Lobster just declared bankruptcy, right? Rite Aid declared bankruptcy. Last year, you had 3 different large franchisees, 2 of which had over 100 units, that declared bankruptcy, right? It does happen. So when that happens, you don't have any income, and you don't have any diversification of income streams. So it's not like, one tenant's paying and one tenant isn't. Another disadvantage is the cost to re-tenant. these boxes are expensive to repurpose, and something that people should always pay attention to. And people are getting in big trouble today in the pharmacy space around this issue is the rent replaceable? Is this tenant paying you $30 a square foot and you're super happy about it, but the market is 12? That happens. I mean, that's the story of big box retail pharmacy today. So that's definitely a risk. Now, all these risks can be mitigated, right? You can mitigate your risk by understanding the financials of the company that you're investing in, because you essentially are. You can mitigate your risk by understanding the financials of the actual location that you're buying. A lot of leases call for mandatory annual sales reporting. So you, in many cases, can know, how is this store doing compared to other stores? That's very important. Another thing, like I said, is making sure that you've got replaceable rent, that you've got a long-term lease, and that it's going to be easy to backfill this property with another tenant should you need to. So there's ways to mitigate this. It's just, you have to go in with your eyes open, and you can't look at this and say that it's, all bowl of cherries, so to speak. The only last thing that I'll touch on is that, yeah, the risk is very low. The level of passivity is very high, very, very hands-off as it gets. But as a reward for that, your return is also, relatively speaking, lower than certain other types of real estate, right? It's not terribly low. I mean, today you can get a single tenant deal anywhere from a 4.5 cap to probably an 8 cap, right? Or a multi-tenant shopping center. I mean, they'll go as low as 5 or 6 cap, but typically 7 to 10% yield. So it's not bad. But you're not getting double-digit returns typically.
Yeah, thank you for explaining that. It sounds like, I mean, this just makes sense, right? Like higher risk, higher reward, ultimately, and vice versa. But it sounds like that to me, from what you're saying, the real sweet spot is like the example that you said is a vacant building that you can then lease to a national tenant like a Starbucks. Turning that vacant Burger King into a Starbucks. That almost seems like the best of both worlds, is where you can kind of probably get it at a low cost, and then if you can get the right tenant in there, lower cost, and then you get the right tenant and have equity upside that you might not have if you're just looking for that sort of long-term mailbox money.
Absolutely. I mean, there's even another strategy. This is one of my favorites, and it's one of the least known strategies in my space. It's called the blend and extend. So basically what you do in this strategy is you buy a short-term deal, and then you kind of do the following. I'm just going to give an example, and the numbers in this example are a little outdated because they're from probably about 3 years ago, but the principle still makes sense. So I have a client that had a Walgreens. He built the Walgreens 23 years prior, roughly, and they'd been paying rent ever since, and everything was great. Well, the time that we started talking, he had 14 months remaining on the lease, which in our space is nothing, right? So 14 months remaining on the lease. He asked me to sell the property for him, and I told him, no, I'm not going to sell it for you. He didn't understand why, and I basically told him, I said, look, right now, Walgreens is paying you $290,000 in annual rent, okay? But there's only 14 months left on the lease. So if we bring this property to market, and granted this was 3 years ago, it'd be about a 9 cap would be what we could expect. So the property's worth about $3.22 million. He said, Dan, I'm cool with $3.22 million. And I said, you shouldn't be, because I'm gonna tell you exactly what I want you to do. I want you to go to Walgreens. And again, remember that number, right? So 14 months remaining, 9 cap, $290,000 rent. It's worth $3.22 million. Okay, $3.222 million. Now watch this. So I told him, I said, go to Walgreens and tell them that you want them to sign a new 10-year lease with you. He said, okay, that sounds good. I said, now they're going to tell you that if they agree to do it, they're going to tell you that they'll do it, but they need you to reduce the rent. And he's like, oh, I'm not reducing the rent. Why would I reduce the rent? I said, just hear me out. Go there, talk to them, see what happens, get back to me. Okay, no problem. He comes back to me a week or two later, and he says, okay, Dan, they agreed to a new 10-year lease, but I'm not doing it. I said, why not? He said, because they wanted to knock my rent down by $65,000 to $225,000. I said, that's great. And he's like, no way. Why would I do that? And you guys might be thinking too, why would I advise a client to agree to that big of a rental reduction? The reason is that at the time, a brand new 10-year lease with Walgreens was actually trading at a 5.85 cap. So despite the fact that rent got knocked down by $60,000 from $290,000 to $225,000, with the new cap rate, because of the security, that deal is worth $3,840,000. Okay. That's an equity buildup of what, 618,000 or so, right? Just by doing what? Just by a stroke of a pen. Now, I'm somebody that comes from a background in house flipping, and I loved buying a property that was distressed, putting in capital, maybe raising money or getting private money to help me, managing the renovations, doing new roof, new windows, new floors, all these things to force appreciation, right? So I could, flip this house or rehab the house. What I love about this is that to you and I, Jason, driving down that street in front of that Walgreens, it looks exactly the same. Nobody swung a hammer. Nobody lifted a finger except for the person at corporate that lifted a finger to stroke a pen. So I love that strategy because you can buy a short-term deal and then you can do this blend and extend, and you can create tremendous amount of equity just by, so to speak, renovating the lease.
Yeah, and I'm sure probably people listening are going to say, well, why would the new buyer want a rental rate that's $60,000 a year
It's
less?
because the risk is lower.
Right, exactly. It's the risk. They don't, for 10 years, they don't have to worry about it. They don't have to worry about that, tenant leaving. They don't have to worry about anything, especially in that triple net lease space. So suppose you run into a scenario where you would have to evict someone, and there's people talk a lot about eviction on the residential side, commercial residential real estate, where you have apartment buildings and you want to buy them in a landlord friendly state because the eviction laws are in your favor. How does that work with something like a triple net lease, or if you do run into that scenario? I would imagine because no one's living there, maybe eviction's not as challenging as it can be in some space, but I genuinely don't know.
Yeah, so it's essentially completely non-existent when you're dealing with a corporate guarantee on a lease. If they decide, hey, we're not doing well at this location, we're going to shutter it, which happens. They cannot stop paying rent because their lease is not just guaranteed by that one location. The lease is guaranteed by the whole corporation, which might have 500 or 5,000 units. So it really doesn't occur, especially when you're dealing with large corporations. Their legal departments know that if they stop paying rent, it's going to create a whole fiasco. Where it is more common is in shopping centers. I just dealt with this on a deal. It's more common in shopping centers where you have mom and pop tenants that, maybe it's, again, Dan and Jason's CBD business. And I'm just bringing that up because that's the one that comes to mind. I had a deal that I was working on without getting into too much detail. I was going to list the property for a client. I brought him an offer off market. Offer said the gym that's in the center has to extend their lease for an additional 3 years. Seller says, no problem. I'm sure they want to stay. Goes and talks to the gym. They said, we're leaving in 2 months, right? And then while he was at it, which happens all the time, he started realizing that he's got one tenant that's not paying. He's got a couple tenants that he doesn't like. So he ended up, doing a lot to the center to get it into a better place. I ended up listing it and selling it for him a few months later. The reason I bring this up is there was a CBD tenant that was not paying. They would just, wait to the end of the month to pay, or they would cause all kinds of problems, and they were doing things that were aggravating the other tenants. And he ended up evicting that tenant. It was a pretty simple process. Again, they aren't living there. The so to speak rights are not the same as someone, when you're kicking somebody out of their home, I think that's one thing. And, judges look at it a certain way, but when there's a business that signed a contract to pay rent in exchange for a space to rent, and they don't pay that rent, I mean, it's pretty straightforward, right? And you're not like putting them on the street. You're essentially getting back your place that they're not paying you for. So it's very uncommon, even in the shopping center space, but it's completely uncommon in the single tenant net lease space for the reasons I described. And it's really something that we very, very rarely come across in general.
Yeah, that's good. So I'm curious on that single tenant triple net lease, like a national tenant with who you say they're not going to stop paying the rent. So what happens? I mean, if they shut down a location, they just keep paying you rent, but they probably want out in some way. So is that something where you might work with them to, they keep paying until you try to find someone to replace that? Or how does,
yeah,
I'm sure that's a scenario that comes up occasionally.
Oh, it's coming up a lot today. I mean, they are contractually obligated to continue to honor the terms of the lease. And, this is something I just made a post about it this week about Walgreens. I mean, this is happening all across the country. There's a Walgreens near my house. incredible location, hard corner, lighted intersection, great traffic counts, great demographics, just killer store. All of a sudden, one day I drive by and it's dark, right? The sign is down, the lights are off. I couldn't believe it. And then I was even more surprised when I looked and I saw that across the street and 398 feet down the road, right, you could literally see from the current location, or the previous location, I should say, was a brand new Walgreens Cooper concept, which is a smaller version of Walgreens.
Okay.
And this is happening all over. So Walgreens is still paying rent on that first location. They have to. They signed a lease. And you brought up a very good point. Yeah, they're saying there, we don't want to be here. We're moving down the street. We have to keep paying. But what they normally do is they offer the landlord a buyout, or the landlord offers the tenant a buyout, which essentially will say like, okay, and I'm making up round numbers, we're paying $200,000 a year for the next 10 years. That's $2 million. How about we just do a buyout now and we'll give you $750,000 or $1 million, something like that. You see what I'm saying? So that way, and that's a win-win because the tenant doesn't have to pay as much money, and the landlord gets to take that buyout and then re-tenant early during a period when they're still collecting some, revenue from the previous tenant. So it happens, it happens frequently. That's what a dark store is. Not only that, but we'll sometimes see tenants who will have a clause in their lease that says that they're allowed to sublease to another tenant. So very often if a tenant like CVS or Walgreens wants to leave and they're paying $350,000, they can sublease to a tenant like Dollar General or Family Dollar for $130,000, and they eat the difference. Landlord doesn't know, he's still collecting the full amount, but it's being subleased to a dollar store. That's another thing that we see as a way for the tenants to kind of, come up with a way to make themselves whole from this money they don't want to pay for nothing.
Yeah, it's a different space than I'm used to, but very, very interesting. I think that it's from a diversification standpoint too. It'd be a good piece for people to have in their portfolio at some level, whether active or passive ownership groups. So cool. Well, Dan, let me switch gears. I'll ask you the questions. And I asked you, these questions last time, but maybe it's been a couple of years, so maybe have some new information. But the first question is always, what is your why? What, you're obviously very successful. What keeps you moving forward?
Yeah, so it's not really one thing. It's a combination. And they would be my family. I'm married. I have 5 kids, 6th on the way. Those are my why. I mean, my daughters are, at this today, the 15 and 12, and they've always been very involved in real estate. I've kept them involved. They do a lot of graphic design. They work on flyers, for my properties for me, all those fun things together. So, my why is not just my family and spending time with my family, but it's building a legacy for my family. It's being able to teach my kids skills that they can then, employ, and maybe if they want to get into this industry, to help them if that's what they want, right? So that's a huge part of it. My why is definitely giving back, educating, and helping people. I love talking to people about real estate. So if you're watching this or listening to this and, you either have a property that you want to sell, or you want to know what it's worth, or, you have a deal you're looking at and you want another set of eyes on it, or, you're thinking about getting into investing or getting into brokerage, or you just want to talk real estate, please, by all means, reach out. I love to give back. It's so rewarding. It's something that for me is what I really look forward to about what I do. So those are definitely probably the 2 largest components. And then, also, I'm a big proponent of financial responsibility and financial freedom. So I have hobbies. I'm a huge car enthusiast. I love going to car shows. I love driving cars and experience cars and all that good stuff. So for me, it's being able to have today I have a certain level of freedom, right? That's part of my why, but in the future, I want to have a larger amount of freedom. So that's definitely a part of my why. I think, again, just to circle back, is being able to help people be financially independent and to be successful and to grow, especially specifically within the real estate or commercial real estate space. That's a big part of what I do and why I do it.
That's great. Well, when people hear this and they want to reach out to you, what is the best way?
So first of all, I'm very active on LinkedIn, as I alluded to, so you can find me there. First name Dan, last name Lewkowicz, Lewkowicz. Again, Lewkowicz. Please reach out to me. Send me a DM. Say that you saw this on Know Your Why podcast, and let's connect. Let me know how I can help. The other way is, I'll give out my direct cell phone. It's 248-943-2838. Again, 248-943-2838. If there's anything that I just mentioned in terms of what I can do to provide value that resonates with you, don't hesitate. I'm here to be a resource, and it would be my pleasure to speak with you.
That's great. Yeah, I'm sure people will want to connect. Dan, this was great. Thank you for coming on the show again. I think actually we covered quite a bit that we didn't talk about last time, so I'm really glad we got to reconnect and get your take on the last couple of years. So thank you for checking in today.
Yeah, absolutely. My pleasure. This was awesome. I really appreciate what you're doing. It's incredible to have 300 plus episodes. So, keep doing what you're doing. You're providing a lot of value to people, which I totally respect and appreciate. And I thank you for your time.
Yeah, appreciate that. Folks listening, do make sure you connect with Dan. And please like, rate, and review the show so we can get more great guests. And thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?